Okay, hi there. It's Jeff here with a revision video looking at the Mexican economy, a really interesting country to study. So it's a high population, upper middle income economy, amongst the top 15 economies in the world by size of GDP. It's about 2%, just under, of world GDP. It's also the second largest economy in Latin America. Mexico has experienced relatively slow growth in the last 10, 15 years. Some people say that Mexico is a good example of a country that's struggling to break free of the middle income trap. But at this moment in time, it's really got tremendous potential to attract investment into Mexico for businesses looking to relocate their operations to North America. And as we'll see, Mexico is a great example of a country to link to the concept of nearshoring. So they have a per capita income of around $12,500, PPP adjusted. It's much higher than that. Over $20,000 suggests obviously the cost of living in Mexico is much lower than in the States. Despite it being a middle income country, over a third of the population are in poverty, and the gap between rich and poor is obviously huge. The income share of the rich is 20%. The fifth quintile is 8.4 times that of the poorest 20%, and their Gini coefficient is above 0.4, which is high, although it has been declining a little bit in recent times. Mexico is 77th on the HDI out of 191 countries. If we take the biggest population nations, they came 22nd in the global competitiveness rankings. And as we'll see, they have a very low unemployment rate, but that's the official measured rate. In fact, hidden unemployment and underemployment is much higher than that. So here's a chart showing the population of Mexico, obviously growing, as you'd expect. 125 million in 2018, rising to around 131 million now, and forecast to rise further to 2028, despite there being millions of Mexicans living and working overseas. Now this chart's interesting. This shows the kind of growth rate for Mexico. Obviously the economy got hit hard by the pandemic. Every major economy suffered that disruption there. But the key point here is that although they've had 2 or 3 good years in 21, 22 and into 23, the growth rate of Mexico is fairly low, fairly weak for an emerging economy. And of course, with population growth, then population growth eats into GDP in terms of per capita incomes. Have a look at this chart. This shows an index of real PPP adjusted GDP per capita. Mexico in red, bumping along the bottom really in the last 25 years, about a sort of 10% gain in per capita incomes. LAC is Latin American countries, just averaging Chile, Colombia, Costa Rica, Argentina, Brazil and Peru. And then we've got dynamic Asia in purple there, including Thailand, India and Vietnam. So you can see that Mexican real per capita incomes have really stagnated. They haven't grown to the same extent as dynamic Asia and Latin America. And also Chile as a little example there. So one of the stories here, one of the big issues is how you can convert. First of all, you've got to get your growth rate up, but can you then convert it into rising per capita incomes and also then into development outcomes? Now, Mexico does have a number of positive, I call them growth drivers. One is an emerging middle class. It's a big country, 130 million people. Middle income, upper middle income country. You'd expect that emerging middle class of consumers to generate consumption and drive domestic demand. As we'll see, it's helped by a significant inflow of remittances from the millions of Mexicans living and working overseas, but especially in the United States. Unemployment is low, a good growth driver, but underemployment is high. We're starting to see Mexico invest more in capital. There's some big infrastructure projects we'll mention, or the state investment. And this is the reason I've chosen Mexico, really, a lot of inward investment, in particular from nearshoring, which we'll talk about in a second or two. So Mexico is becoming increasingly an export-led economy, helped by a big labour force, competitive wages, low unit labour costs. One of the dangers for Mexico is that they need to move away from made in Mexico, sold from Mexico, towards made in Mexico, consumed in Mexico. In other words, drive internal demand. But trade is an engine of growth for Mexico. It's now the biggest import provider to the United States, and it's overtaken China. So we talk about infrastructure. There's the Dos Bocas Sol refinery. Mexico at the moment is a net importer of oil and gas, but the oil refinery is designed, I think, to some sort of daily refining capacity of nearly 1/3 barrels per day. And when fully completed and up to capacity, that will have a significant effect on Mexico's net trade in oil. The Mayan train, this $20 billion rail route, basically connecting the Yucatan Peninsula. And one of the aims there is to really try and drive tourism, particularly in some of Mexico's less developed states. Part of that train network has actually been built by the army. It's controversial, environmental consequences, cost overruns, a controversial investment project. Talks about remittances. Now look at this chart. This is remarkable. This is 2022. Percentage share of GDP of incoming postal remittances in Latin America. So countries like Honduras and El Salvador and Haiti, obviously in the news at the moment, over 1/5 of their GDP comes from remittances. They are really highly dependent on remittances. Mexico down at 4%, just over 4%, but of course it's a much, much bigger economy than any of those shown, really. So 37 million people of Mexican origin live and work in the United States, for example, and they send back around $60 billion a year in remittances. So that's a big inflow. Unemployment is low in Mexico and has been falling. Obviously, it went up during the start of the pandemic, but it's at around 3%, which is very low. But dig beneath the surface, underemployment is very high. So if you look at unemployment plus those available to work plus the underemployed, people whose hours, for example, are not really full-time, or people in temporary work, then underemployment and the true unemployment figure is probably closer to 20% if you add underemployment in there. So as I say, Mexico is a country whose trade is really driving their growth. Trade in total, if you add exports and imports together, the value of trade, not the balance, but the value of trade is about 90% of GDP. As we'll see in a second, highly dependent on the states, really high dependency. Obviously, Mexico originally signed NAFTA, and in 2020, NAFTA was replaced by USMCA, tripartite trade agreement between the United States, Mexico and Canada. But Mexico signed a whole raft of free trade agreements with the European Union, with Japan, and of course it's a founding member of the Pacific Alliance along with Colombia, Chile and Peru. So this chart really shows, it really emphasises, doesn't it, the trade dependency, that over 80% of Mexican exports go to the USA, and then probably about 85% if you include Canada there. In terms of what Mexico is exporting, well, this is our export pattern map, and you can see that cars take up the single biggest goods export. Travel and tourism about 4%, cars 8%, parts of motor. So if you add the motor industry as a whole, you're talking over 20% of exports. Computers, medical instruments, refrigerators, pumps for liquids, etc., tractors. So Mexico is a really good example to have in your revision notes of a country whose manufacturing sector is a key export industry. Monitors and projectors, insulated wire, electrical boards there in turquoise, beer, obviously Mexican beer, spirits and alcohol, tomatoes. So Mexico actually has quite a diversified industrial base, from energy to farming to manufacturing, which is important for a country like Mexico. And a lot of the inward investment into Mexico relates to manufacturing. In fact, over half, 53%. About a third is financial and insurance services, which is an interesting point there. Less than 2% is hospitality. So I think Mexico is a good example of a country you can choose that is increasingly export dependent, attracting foreign investment coming in. And I would link Mexico to the concept of nearshoring. Now, nearshoring is what's happening in the world economy. It's the relocation of production towards a country that's geographically closer to the firm's country of origin. And we've seen quite a bit of nearshoring in the last 5-10 years, really. Obviously, the COVID pandemic disrupted global supply chains. So a lot of businesses sensing that, experiencing that, want to move manufacturing closer to the point of sale. The war in Ukraine has hampered these things stall further. But nearshoring really predates 2019, 2020. It really kicked off in the mid-2010s. In particular, a lot of US companies started nearshoring when trade tensions built up with the first Trump administration in 2018. Interesting now, China now exports to the States via Mexico. So cars imported into the USA from Mexico are given a 2.5% tariff. Parts put together in Mexico, somewhere between 0 and 6%. So fairly low tariffs. But cars and auto parts imported directly from China into the USA, 25% tariff. So, this is an obvious consequence. The differentials in tariffs and things mean a lot of Chinese companies are now investing in Mexico, producing, assembling in Mexico, and then exporting to the States. So Mexico, in theory, should be growing at 3-4% a year, but it's not. So Mexico is a good example of a country whose growth is a little bit lagging behind where it needs to be. So what are some of the barriers to growth and development? Well, these are fairly, in many ways, predictable, but there are big regional differences in living standards and poverty, persistently high Gini coefficient, and also very large gender inequality holding the economy back. If you can lift per capita incomes and make them more equal, oftentimes you can drive more consumption. Government spending is fairly low. Debt is low, but government spending is low in part due to low tax as a share of GDP. And of course, if they could raise more tax, that would allow them to spend more on things like education, healthcare and housing, and therefore lift productivity. Mexico is seen as a country held back by underinvestment, both in infrastructure, education and renewable energy. We'll see in a minute they have a very relatively weak productivity growth. So their GDP is high, but their GDP per capita needs to be much higher than that. There are environmental issues. Mexico suffers from one of the highest rates of deforestation. A third of the land area is regarded as severely degraded, and increasingly now severe water shortages. The drought that affected their farm sector in 2023, for example, are a big threat both to farming and also inward investment, because inward investment needs water supply and needs reliable energy. And perceived corruption is also very high, security issues in particular related to drug trafficking. So here's a few charts on growth barriers for Mexico. You can see here they are amongst OECD countries, a range of other countries. They have very low tax revenues, only about 17% of GDP, whereas for most high-income countries it's well above 30%. Corruption Perceptions Index, this is the published every year, but I think it's by Transparency International. A score of 0 is the worst score you can have, a score of 100 is the best. Mexico scores 31, which is, again, well below in the average for Latin American countries and well below developed nations. And the Mexican Institute for Competitiveness estimates that 5% of Mexican GDP is lost to corruption each year. Link this to remittances, by the way. There's some evidence that, billions of dollars flow into Mexico from remittances. And there's some evidence that quite a bit of money laundering, ill-gotten gains from drug trafficking, feed through the remittance system. Here's an interesting chart showing labour force participation. So for men, it's around 80%, touched under 77%. It's barely changed. For women, it's less than 50%. So there's a big gender gap in terms of labour force participation, and underutilised resource there. Now you can see in Mexico, in relative terms here, compared to other OECD countries, is well below. Turkey has an even lower figure, 40%, than Mexico, than Italy, then Costa Rica. And countries like Sweden and the Netherlands, it's way above 80%. And we said that Mexico's growth is held back by productivity. This chart shows GDP per person employed, adjusted for PPP, since 1992. The blue line there is the OECD average. It's the kind of industrial countries, and Mexico is an OECD country. So productivity is 45% higher in 2022 than it was 30 years before, 1.5% growth. A bit per year. In Mexico, productivity is actually lower. GDP per person employed is lower in 2022 than it was in 1992. So Mexico is one of the things holding Mexico back is low productivity. Can foreign investment make a difference there? Can increase investment in education and skills make a difference? compared to Latin American countries, including Chile, Colombia, Argentina, Brazil. Mexico has a low share of energy from renewables. It's a net importer of oil and gas, just at 20%. So why would you use Mexico as a little case study? I think it's a really good little country to study. It's a big country, but a good case study to study. First of all, the impact of deglobalization and the rise of nearshoring. Mexico probably stands to gain from that. Obviously, it has a sort of 2,000-kilometre border with the United States. Lots of manufacturing plants just set over the border to invest and then export to the States. Mexico has embraced the idea of free trade. Lots of free trade agreements. Consequences of for attracting FDI. But as we've just seen, there are lots of structural factors limiting their growth and human development outcomes. And really, Mexico is a country that is a middle-income country. It's an upper middle-income nation. But can it achieve the structural change? In particular, can it drive up productivity and improve human development to lift it to a high-income nation? Relatively few countries have gone from $14,000 per capita to $25,000. Maybe Greece, Israel, South Korea would spring to mind. Relatively few countries make a smooth transition from middle income to high income. Will Mexico get stuck with a growth rate of 2.5%, which is not enough to achieve its outcomes? And likewise, a really good example here of the consequences of climate change. Mexico is exposed to climate change and the associated need for infrastructure, in particular renewables, water, to sustain what they hope will be a faster growth rate. Well, there we go. 15 minutes on the Mexican economy. I hope you enjoyed it. I hope you found it useful. Thanks for joining in. There will be lots more country focuses as we head towards the exams. Take care, stay safe, stay curious, and see you sometime soon.